Over the last 3.4 years, I took 2,887 trades using moving averages. That's 41 months of trading, 1,224 days. I want to save you that time and teach you what I learned over this period. Hi everyone, I'm Pedro, and today you will learn how to really trade with moving averages. Moving averages work like magnets. When we are on an uptrend, the price will tend to jump on the moving average and then make another leg to the upside, making new highs. It jumps on the moving average and makes another leg to the upside, making new highs. When we are on a downtrend, it's similar but the opposite. The price makes legs to the downside, then it comes up to meet the moving average, and then it makes another leg to the downside and keeps repeating this while it's on a downtrend. On this chart we have an example. We have this line that you can see here, which is a moving average. And you can see that the price makes a move to the upside and then it comes to the moving average. And here it's rejected, it makes another move to the upside, and then it comes to the moving average again, where it's rejected, making new highs every time that goes up again. At some point, the price breaks the moving average. We have the moving average here. The price breaks, it goes to the moving average, and then it's rejected to the downside. And here it's a possible downtrend starting. Now, what do I expect to see when the price touches the moving average? I want to see some kind of rejection here. I don't want to trade to enter as soon as the price touches the moving average. I want to see here a rejection pattern. And this that you see here, this red candle that hits the moving average, and then this big solid green candle that deletes the previous red candle, this is a pattern of rejection. It's commonly called as an engulfing. We have this candle engulfing the previous red candle. And the biggest the amount of red that we see being engulfed by this green candle, the stronger it tends to be the signal for the price to make the next move to the upside. We can see here on the second touch, we have another engulfing. We have a decent amount of red that is engulfed by a green candle after the price touched the moving average. And then when we have the trend change, the possible trend change, we see the same thing but inverted. So now we have a green candle that tried to break the moving average to the upside, and then it was completely deleted by red. So this signal that we see here, it's the same as these ones, but it's just inverted. And where are my entry points? I like to enter as soon as this red candle is broken to the upside. So as soon as this high here is broken, this is where I hit my buy button, and then I ride my trade and I try to get out somewhere above the previous high. Here is the same. We have the red candle. When the red candle is deleted by this green candle, at this level here, I would hit my buy button and then I would wait to close my trade somewhere above the previous high. When the price breaks the moving average, it's the same thing. We have the green candle. When the green candle is deleted by red, here is where I hit my sell button and then I close my trade when the price makes new lows. So this is the first pattern. Let's look at the second. So here we have another uptrend. We have the moving average, which is this line that you can see here, and you see the price jumping on the moving average. And the second type of pattern that I like to enter my trades, it's this candle here. It has a small body and then it has a big wick at the bottom. When we are on an uptrend, ideally we want to see big wicks at the bottom of the candles. These kind of wicks, it means that the price is being rejected to the upside. And this kind of candle is actually pretty similar to the other ones. It's the same movement, but that happened faster. So at some point, this candle, it was a red candle like this on the first part of its life. And then on the second part of its life, it turned green and it went up. So you can see that this is pretty similar to the other kind of pattern that we saw on the previous example. So this is the second type of pattern that I like to use to enter my trades. And as soon as I see this candle closed, and as soon as I see the top of the candle being broken, this is where I hit my buy button, and then I let the trade run, and ideally I try to close it somewhere above the previous high. And then we have our possible trend change. The price breaks the moving average to the downside, and when it goes to retest the moving average, it leaves a candle with a small body and a wick at the top, and wicks at the top means that the price is being rejected on the upside. So my entry here, as soon as this candle closes and the price breaks the low of the candle, this is where I hit my sell button, and then I let my trade run and close at new lows. Guys, these examples here, what we see here, this is what it's called trend trading. We are trading with the trend is up. We just think about going long, the price is above the moving averages. When the price crosses the moving average to the downside, here we start thinking about shorting. So we wait for rejections at the moving average. That's where we try to enter, and then we ride the price and get out as it makes new lows. If you want to learn more about this strategy, you have a link on the description of this video where you can get a free 6-day trading course. Now here is another tip. I like to use two different moving averages, two moving averages that follow the trend. The ones that I like the most are the 20 period moving average and the 8 period moving average. And why do I like to use two moving averages? Because the 8 period moving average, it's a moving average that it's very fast, it adapts very fast to the price movements. But trends that are at some point respecting the 8 moving average are trends that are not sustainable for a long term. So at some point they will try to retest the 8 moving average to make a new low, but it will fail and it will go to the 20 moving average. The price needs to have a longer breath, it needs to breathe some more before it makes a next move to the downside. And then eventually it can come close to the 8 moving average again and make a new leg to the downside. But since this is not sustainable for a long time, we can have 1-2 touches, but after some point the price will tend to go to the 20 moving average again to rest some more, to have a bigger breath, and then make another move to the downside. So this is how I use two moving averages to trade. Some of you may ask, oh, but I liked, what about the 21 moving average, or what about the 9 moving average? They are pretty much the same. If you plot the 8 moving average and the 9 moving average, you will see two lines pretty much close to each other. And if you plot the 21 moving average and the 20 moving average together, you'll pretty much see two lines very close to each other. So it doesn't really matter, they are pretty much the same thing. Now, what kind of pullbacks do I like to trade? Because not all the pullbacks are the same. Although we may have the same reaction on a moving average, it also matters how the pullback starts. And the best pullbacks, the ones that tend to give you better odds of continuation of the price making new highs, are the pullbacks that have small red candles, are pullbacks that are smooth. We want to see some kind of 45 degrees or so. So from what we learned earlier, we have now the price here above the moving averages. It's now hitting the 8 moving average. The pullback is smooth, more or less 45 degrees. And now we just want to see a bull candle, some kind of engulfing here, since this candle closed somewhere here pretty close to the moving average. If we want to go long, we want to see some kind of engulfing here. And what happens? Nice green candle. We enter there. As soon as this candle is broken, and then above the previous highs, this is where we start thinking about closing our trade. And let's see what happens next. We see the price coming to the moving average again. We see this red candle, and when we see this red candle that basically touched that moving average there, we wait for the price to start going up. We have this level here that we want to see broken. And what happens? Nice entry here, guys. As soon as the price starts making new highs, we can close our trade. We don't need to close it all at once. We can close it in partials, but this is what you want to see and what you want to wait every time. But don't learn just from me, you can learn from my traders. Look how they trade, look what they do. This is Nasdaq, the 2-minute time frame. The price was on an uptrend when it approached the 8 moving average. When the red candle is closed, you can see that small green arrow there. This is where these of my members entered. And he didn't let it run much because there was a resistance here. But it was a beautiful move where he got 11 points trading the Nasdaq. Guys, trading is as simple as this. Let the price come to the moving average, seeing green candles engulfing the last red candle, that's your trigger to enter, and then you close. And my members do this really well. Guys, now look at this. This is the second type of pullbacks. In our previous example, we were talking about 45 degrees more or less pullbacks. But here, the price starts the move with a huge, strong red candle. And this is not what we want to see. When you see a pullback that starts with a really strong candle, a candle that engulfs a lot of the previous green candle, this is a bad sign for the continuation of the trend. This should not be expected immediately. On an uptrend, we want to see big green candles and small red candles. When you see a big red candle appearing, this is a bad signal and this is not the kind of pullback that you want to take. You don't want to fight this big red candle. Let's see what happens after this. The price actually broke this 8 moving average, which makes it even worse for a continuation of the move to the upside and expect the price to make new highs. This is not what you want to expect. So when you see this red candle being engulfed by this green candle, this is not your entry, guys. It's not your entry because of this. Also because the price broke this moving average, but even if this moving average was here and there was nothing here at the top, this is something that you should not expect. And what happens after this? As you can see, the price tried to go up, but it was immediately rejected again to the downside. On the 20 moving average, it still tried to reject and left this wick here, but it was not enough and the price just broke the moving averages to the downside. And now we actually have here another possible entry, and now to the short side. We have the moving average, we have the price going pretty close to the moving average. It doesn't need to touch them exactly, this is close enough. And the break of this candle that rejects the moving average and even deletes, engulfs this previous green candle, this is another possible entry, and here we want to go to short and try to close our trade on a lower level. And again, let's see what my traders do in these situations. Look at what happens here. The price was on an uptrend, and here we see a strong red candle, a big red candle that engulfed all these previous green candles that we see here. Do you see how big is this red candle compared to the previous ones? This is something that you don't want to see if you are thinking about going long. So if you are thinking about going long and you see a big red candle like this, you don't want to go long and fight this red candle. But my member here, he actually tried to go long. You see this small blue arrow there? He tried to go long here, which was a mistake. He tried to fight this, but as soon as the price started going down, he closed his trade. You see one red candle, and then he immediately shorted. And this is the perfect entry. He immediately saw that he made a mistake, and when the price broke this green candle, he closed his long position and immediately he entered short, and he closed it there for a really nice profit. And guys, look at this. This is the size of the loss, and this is the size of the profit. When you have a loss with this size and a profit with this size, this is something that you probably want to try to do every time. You don't want to have a very small profit and you need 2, 3, 4 profitable trades to recover a loss. You want to recover one loss, or eventually you want to recover 2 losses or even 3 losses, be able to recover 3 losses within one single trade. Psychologically, this is the best thing that you can do. So far we only saw possibilities of taking trades when the price meets the moving average. But we can also take trades when the price is starting to go to meet the moving average again. Although these ones are trickier and they are possibly more advanced to take, sometimes there are good opportunities, and those opportunities appear when the price makes a strong move, getting really far away from the moving averages, and then it leaves one of those patterns that we saw earlier. It can leave a bar with a pin at the top. You know that the wicks, these pins, these wicks means that the price is being rejected from the top. After a big move and the price is far away from the moving averages, and you see that wicked bar there, this is a possible short opportunity that you can take. So if you see the price breaking the low of this candle, you can eventually short this and try to target the next moving average, which is, in this case, it's the 8 moving average. You just have to be careful with something. If the price starts going down and printing more candles, the 8 moving average will go up, will keep going up and very fast, and it will meet the price very fast. So if initially you have a distance here, that it's a possible good distance to make some profit, you don't expect a vertical move of the price reaching this point immediately. So as more candles are printed on your charts, you should expect some kind of smaller profit than what you see earlier. So let's see what happens. Whoa, nice move. So guys, why did I told you to close your trades here at the 8 moving average? Because here it's a possible turning point. Because this moving average on an uptrend is acting as a support, and here is what we want to see things happening. we have clear space to move until this 8 moving average. So this is a good spot to close, but now we don't know what's going to happen here. Now it's difficult to try to predict what's going to happen here. We need to wait. We can have a big green candle appearing here, and this would be a possible signal to go long. But we need to wait to see what happens. What happened here is that the red candle, it broke the moving average. So we don't expect a big move, and actually look at the size of this big red candle. You already know that you don't want to see big red candles like that. This is a possible signal that the price wants to go lower. But the thing here is that you want to be far away from the moving averages to try to go counter trend, to go and take a counter trend trade and target the next moving average. But let my members teach you how to do this. So this is an example where one of my members got 13 points trading DAX. The price made a big run above the 8 moving average. It left a pin bar here with a wick at the top, and when the price broke this wicked candle, this is where he shorted and closed when it hit the 8. Perfect trade, perfect move. 13 points. This is 1 minute chart, guys. So this was 1 minute. In 1 minute and a few seconds, he was in and out and his day was done. How cool is this, guys? Another tip for you guys, trading inside the moving averages. If you see the price on an uptrend and then you see it breaking the first moving average, and even better with a strong red candle, here you may have a possible short opportunity. This moving average, that first it was acting as a support, but now as the price breaks and closes below the moving average, it will tend to act as a resistance here. But at the same time, we have the other moving average, the 20 moving average, which is slower, but it's still working as a support. So we have the support here and we have a resistance here. What we can do in these situations, we can wait for the price to hit this faster moving average, to reject the faster moving average, and when the candle that rejects the fast moving average is broken, you can possibly short here and target the next support, which is the next moving average, the slower one. So what happens here? The price broke the candle that was rejected from the fast moving average and it went to the slower moving average. This is where you can close your trade. Because now we are on that situation where you don't know what's going to happen. This 20 moving average may push the price to the upside again, or it may eventually break and start a downtrend. But now we need to see how the price reacts. Here it broke, it made a leg to the downside, and now it came up again and it's inside of the moving averages again. And what do we want to see here inside moving averages? We are inside. When we are inside, we want to see an eventually break of the high of this candle and target the next moving average there. And what happens? Beautiful, no guys? Beautiful. You could close your trade there. Price broke. Red candle being deleted somewhere here. Here you could enter, and this is where you could close your trade. What happens next? Now the price makes these two pullbacks that we saw earlier, and now look here, the price breaks again the 8 moving average to the downside. Then it starts going up, green candle. It's retesting, it's going to retest this 8 moving average. If it comes down again, the break of this green candle, it's a short signal and target the next moving average, the slower one. And what happens is... Guys, how cool are these things? Trading is so simple. Trading can be so simple when we don't overcomplicate. Guys, now look at this. This is very important. For those of you who follow me for some time already know that I like and prefer to trade the open of the markets. And this is why. Look at it. This was the volumes before the open, and when the volumes increased, this was the open of the market. In this case, this was the open of the US market, and this is the Nasdaq 1 minute time frame. And let's say that it's here. It's more or less the 30-minute mark after the open. So the open starts here, and 30 minutes later, the price is here. I want you to look at the size of these candles, at the size of these candles, at the size of these candles, at the size of these candles. And here, even before the 30-minute mark, look at how small the candles start to be, how small these candles start to be, how small, and the price is moving so slow now. It's not that it's not possible to trade, but here while we can take a trade and in 1-2 minutes we are out, we have our day done, we don't need to look at the charts anymore. We see a pullback to a moving average. As soon as the price breaks the previous green candle, engulfs the previous green candle, we short, and in 1 minute sometimes we are done for the day. We just need to wait for the right setup, and there are plenty appearing in the first 10-20 minutes. After some point, these things start to slow down so much that to get the same amount of profit, if you enter, let's say here or here, look at how many candles you need to wait for the price to break and make something similar to this, you know. You need to wait all these candles, 10 candles, 15 candles to make a move that is similar to a move that you can catch in 1 single minute during the first 20 minutes of the open. So it's so much better to trade this, to just be exposed to the market 1 or 2 minutes, 1 or 2 candles and close. You don't need to fight your psychology. You don't need to be questioning yourself every single candle during 20 minutes if you took a good trade or not, or if you should avoid that entry or not, because you will be questioning yourself all this time until the price does something. So much better to trade these fast moves in 1-2 candles, you are out. And that's why I encourage everyone to try to trade the open of the market. The movements are much clearer too. They are not as messy as this, not so much sideways. So these are the best times that you can use to trade using moving averages. And then are the ones that like to trade messy times of the day like this. Guys, when you see a chart like this is not to be traded using moving averages. This cannot be traded using moving averages. The price here is just moving sideways. Our moving averages are almost horizontal in the middle of the price. And moving averages are not indicators to be used to trade sideways moves. Moving averages are indicators that are used to trade trends, either to the upside or to the downside, when the price is trending. And when does the price trend more? It trends more when the markets are open, especially at the open, and ideally during when they are still open. This kind of messy moves tend to appear more times when the markets are closed, when the US session is closed, when the London session is closed. And if you try to trade with moving averages when the markets are like this, you are just going to be hit over and over and over again and just blow your account ultimately. One last thing that I want to share with you, maybe you have no idea, but a 10-minute video takes me about 10 hours to make, and that's a lot of my time. So if you want more of these kind of videos, please let me know in the comments, and also suggest me what other type of content you would like to see in this channel. Thanks for watching, don't forget to subscribe, and I see you again on the next video.